had pretty dramatic moves at the long end. We're bearish trend now, at both the 10-year and the 30-year. Of course, that's also been reflected in the 30-year fixed rate mortgage. So mortgage rates have come down from basically late October. They were at about 7.8%. This is the Freddie Mac primary mortgage market survey. Now down to 7%. We'll get the update for the most recent week in a couple of days on Thursday. But what's interesting is looking at the reaction function on the MBA series, both purchase and refi. So the purchase index series for this is the MBA, or Mortgage Bankers Association, and we're talking about mortgage applications and being distinct between the purchase side and the refinancing side. So on the purchase side, the lows in October, the index was around 125 to 130. That was down about 60% from the cycle highs in early 2021. As of the first week of December, that had risen from a range of 125 to 130 to 150. So up about 15 to 20% on the back of that sort of 80 basis point fall in rates in a span of about 6 weeks. On the refi side, I think it's also interesting. Had some lively debates behind the scenes over what the sort of trigger levels are for any kind of real reemergence in refi activity. So one thing to bear in mind is that this index, the refi index, it's down about 95% off its 2020 levels. So it sets a pretty easy comparison framework. Those refi volume levels on an index basis troughed at 340 to 350 in late October, and as of the first week of December, the index was at 445. So an increase of about 25 to 30% in refi activity in the last 6 weeks or so. Remember, off what might just be the all-time low in terms of comparative base effects. Yesterday, we got the NAHB data for December. That's the National Association of Home Builders Housing Market Index, basically builder confidence. We saw bounces across the board. We saw traffic pick up by 3 points in December. We saw expectations for next 6 months sales pick up by 6 points from November to December. And present conditions were unchanged at 40, but also are notable in that all three of these series had peaked either in July or in June. So the next 6 month expectation peaked in June. The present conditions and traffic series peaked in July. Every month since then through November, all of those series have been declining and declining pretty quickly. So November, or rather December, marked an inflection in that both traffic and expectations bounced and present conditions stopped going down. So the names that we've put out there on the existing home side as longer term, intermediate to longer term plays on this sort of recovery in volumes on the existing side are the title insurers. So FAF, First American, and FNF, Fidelity National. These are mid-cap stocks. FAF's about $6 billion, FNF's about $13 billion. And in the last, so we put these ideas out in early August. So in the last 4+ months or so, FNF is up about 20%, FAF is up about 5%. So I still think these are compelling ideas over the intermediate to longer term as this market continues to renormalize and so forth. So just wanted to spend, and we did our housing deck very recently, where we basically boiled the ocean across both the new and existing home landscapes, gave our whole framework for that. And so anybody interested can check that out. They can check our title insurance deck out from early August.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.